Good afternoon, everyone. My name is Janmeja Singh, and I am an assistant professor of law in BPT University. My topic for today's lecture is Offences and Penalties under Income Tax Act 1961. Let's start. Timely and consistent paying of taxes and filing of returns ensures the government has money for public welfare at any point of time. To make sure the taxpayers do not default in paying taxes or disclosing the information, there are several penalties prescribed under the Act, under the Income Tax Act. A penalty or a punishment is imposed on the taxpayers for being non-compliant. Listed below is a summary of some of the important and most common penalties. It is important for the government to receive a timely collection of taxes to go about its function. There are primary three modes of ensuring compliance. First, changing of interest. Second, imposition of penalty. Third is launching of a prosecution. Charging of interest is mostly for minor and technical issues like delay in compliance. Late payment, for instance, this is compensatory in nature. On the other hand, penalties and in prosecution are punitive in nature and serve the function of being deterrents against tax defaulters. There are various provisions for penalties in the Act. For instance, a penalty of 25,000 for non-maintenance of books of accounts under Section 271A. But apart from the penalties for defaults, the Act also curves out offences for worst cases which will invite prosecution. This prosecution for more serious, willful acts of non-compliance are necessary for prevent tax evasion, as there exist many legal persons that can afford to take the risk of evading taxes for good profits and pay the definite penalty amount in case that they get caught. A prosecution which consists of likelihood of imprisonment, and as in most cases of prosecuting sections under the Act, an indefinite amount of fine thus serves as a better tool against such acts. The amounts of penalty will be as determined by the assessing officer. However, the amount will not exceed the amount of tax in arrears. Next point is non-compoundable offences under the Income Tax Act. There were certain guidelines in 2014 issued by the central government of direct taxes operating over compounding of offences under the income tax law, which have recently been replaced by a fresh set of guidelines issued on June 2019, which would operate over application on the after 17th of June 2019. These guidelines have both liberal and stringent provisions. Category offences under the guidelines are technical offences that can be compounded in up to three occasions. Category B offences, on the other hand, are non-technical offences that can be compounded only once. Offences not found in either of the categories are non-compoundable offences. However, there are certain offences as well that they have been made non-compoundable. Some of them are the following. Section 275A. This section penalizes contravention of an order made under Section 132, subsection 3 of the Act, Income Tax Act. The order is made when it is not practicable for an officer to seize any material physically at the time of the search, and the person in immediate possession is direct not to deal with it anyway. Thus, when a person deals with the property despite such an order, he is punished with rigorous imprisonment up to 2 years in addition to an undefined fine. Point number two, Section 275B. This section penalizes failure to comply with provisions of Second B of Section 132(1). This provision requires a person in possession or control of any electronic records to afford the officers in a search the necessary facilities. If not complied with, a person is punished with imprisonment of up to 2 years with an indefinite amount of the fine. Next point is section 276. This section penalizes the concealment, removal, transfer, and delivery of property with the motive of recovery of tax. This involves fraudulently dealing with the property to obstruct execution of recovery of tax. This is also punished with imprisonment of up to 2 years and an indefinite amount of fine. Thus, the above offences are serious in the sense that they are not compoundable in the nature. If the income assessed or reassessed exceeds the income declared by the assessee, or in cases where the return has not been filed and income exceeds the basic exemption limit, penalty at 50% of tax payable on such under-reported income shall be imposed. 200% of the tax is payable if under-reporting results for misreporting of the income. Normally, the amount of penalty is 25,000. In case the SEC is a person who has entered into international transaction, the penalty will be 2% of the value of such international transaction or specified domestic transaction. However, there are other indicators as well, including the most common offences and the ones with higher quantum of punishment. Notably, recently in September 2019, the Central Board of Direct Taxes issued a directive on prosecution of income tax offences. It prescribed certain thresholds for offences to avoid petty tax litigation. In the cases of not disposing tedious, willful attempt to evade tax, and failure to furnish a return of income, prosecution would only be initiated if the amount involved is more than 25 lakhs. These offences cover the bulk of income tax litigation and are serious in the respect that in the cases of the amount indeed exceeding 25 lakhs, this section themselves provide a significantly higher punishment than the other offences. And Section 276B and Section 276BB, under this section, a person that does not pay to the credit of the government the tax deducted by him at source of or the tax collected by him at source shall be punished with rigorous imprisonment of 3 months to 7 years and an indefinite amount of fine. This offence is dealt with seriously since these amounts are kept with the employers in a fiduciary capacity and in fact belong to the government. The employer can the employer can't finance his business through government money, and not measure of economic difficulty can therefore justify this lack of. In case the income tax officers finds that the books of accounts provided by the assessee in the proceeding contains the following: forged documents such as a fake invoice or a false piece of documentary evidence, an invoice in respect of supply or receipts of goods or services issued by any person without actual supply or receipt of goods or services, an invoice of supply or receipt of goods or services received for a person who does not exist, an omission of any entry which is relevant for computation of total income, then the assessee might have to pay a penalty of the amount equal to sum of such false or omitted entries. If the taxpayer proves a reasonable cause for failure or making defaults listed in section 273B, the penalty proceedings may be waived off by the assessing officer. Some of the examples of defaults listed are: point number one, failure to keep, retain, or maintain books of account, documents, etc. As per section 44AA, deducts TCS returns. False estimate or failure to pay advance tax. At the end, there are various other cases wherein a higher quantum of punishment is prescribed. For instance, under section 278, if a person furnishes a false return of income and the amount involved is more than 25 lakhs, the imprisonment of 6 months to 7 years plus fine. Similarly, Under Section 277, display of false accounts to evade tax invites similar punishment. Also, all second time offences, in the case of not paying the tax deducted or collected at source to the government, willfully evading taxes, failure to file returns, submission of false returns, and display of false accounts all invite the similar magnitude of punishment. Most of these offences, having a maximum punishment of 7 years, do not have knowingly as an ingredient, and thus mens rea does not have to be proved. Thus, these offences are dealt with strictly as per the letter and is presumed unless the accused can show reasonable grounds as circumstances for any instance. Thank you so much.